Okay, so in this video, we're going to set up a bull spread with put options. And you can see that as the underlying asset price increases, we get a higher payoff, a more positive payoff as the asset price increases. ST denotes the asset price, the terminal asset price when the option matures. And then here on the vertical axis, we have the profit. The bull strategy is set up using put options. So we have a long put combined with a short put, where the short put has a higher exercise, and then the combination of the put positions creates this portfolio or combination or trading strategy. Okay, so we're going to estimate the premium here that we can identify using the Black-Scholes model. We go into Vinegar Hill. We can copy the Black-Scholes Merton VBA code here. It's from Kerry Back, and I've left the link. So just Control-C, and then we go into our spreadsheet and come over to Developer tab, then Visual Basic, then look for the name of our workbook, and we're putting in a module, okay, which is already here. So it can act because we've one there already. We can remove, and we don't want to save it anywhere, and we'll just paste. Okay, Control-V. So we've Black-Scholes put, Black-Scholes call. We're in this instance going to be using Black-Scholes call. Let's go back into the spreadsheet again. We'll set out, we might, just for ease of exposition, take the name of the function and parameter arguments, and we'll make those visible here just underneath, right? That might be useful. And so we'll set up, look, we have different stock prices. We have a stock price. We have an exercise. We have a risk-free rate. We have sigma, and which is the volatility of the return. Q is the dividend. T is the maturity. So the stock price, underlying asset price, the exercise, on the option, the risk-free rate, the volatility of the asset price return, the dividend as a percentage in time in years. And we'll set out our usual values. Risk-free rate is 5%. We're expressing S and K as a dollar amount. Sigma is 20%. Volatility we'll say is 0. T is equal to 1 year. And then to estimate the value of the put option using Black-Scholes, the user-defined function that we just entered in, Black-Scholes put, now auto prompts, come up to FX, S will load in, K will load in. So each of these map across. R is 5%, sigma is equal to 20, Q is equal to 0, and T is equal to 1 year. Right, and then hit return, and we get 557, and we know that that's consistent with typically what we have. Okay, so we have a long put with a lower exercise. Okay, so we're going to say long put, and then we should have a short put position, right? And these are just for the moment really labeled, so nothing fundamentally changing here, but short put. And the key thing is with this short put, we should have a higher exercise. Now, a simple way of making one column the same as the other is just to set equal to the previous cell, then that follows all the way down. And the exception being here, we will go with a higher exercise. So 140, we'll just hardwire that in, 140, okay? Now, to set up this payout, we need to generate the long put. Okay, so the long put again, what would that look like in terms of payoff? Well, we need to set out different asset prices. So we're going to set out what's on the horizontal axis. and then we drag that down, and we'll go down to 200, and then we'll generate, we'll say maximum of the stock price minus the exercise for the lower. So we have a long put with the lower exercise, so it must be just 100. It's the lower exercise here. We'll lock the cell reference by hitting F4, right? So FN F4, and then 0. Now, also, it's the other way around, right? It should be the exercise price for a put option. It's the exercise price minus the asset price, the exercise price minus the asset price. Let's drag that down. I think it looks okay. And then just to get a quick overview of what's in there, right? Let's just map that. And you can see, okay, look, I have the long put payoff being generated. Of course, what's missing here is the premium. We haven't included a premium, but a quick fire way of getting the premium in here is just subtract away the premium that we had estimated for the put option with the lower exercise. So it's basically equal to the long put minus the premium FN F4 to lock the cell reference, and then we can drag that down and then set it up. And to incorporate that in, it's not that difficult. We can right click, select data, add long put, I would say with premium, because it has the premium here, Black-Scholes premium. And then what's on the horizontal axis, it's the asset price. What's on the vertical axis, it's the profit from the strategy that incorporates the premium, and hit OK. And you can see here, we now have the long put, and the premium is also incorporated in. Now we can remove the blue, right, because we no longer really need that. So I'll just take it out. Okay. Now, next bit of the charting here, we have the profit chart and we have the payoff for the long put, but what about the short put? Okay, so the short put, right, we'll do it all together. Short put position, and note that it's the one with the higher exercise. Now I can just drag that across and it'll estimate automatically the value of the put option premium, right, using Black-Scholes. So no problems there. What about the short put? Well, it's equal to, we can say negative maximum, open bracket, the exercise for the higher, so it's the exercise, X2, the exercise for the short position, which is the higher exercise. We want to lock the cell reference, so FNF4, right? We've locked the cell reference. What are we subtracting? Stock price, close brackets, and then minus the premium, which is 33, and we'll lock the cell reference on that as well. Now we have to be careful. Put a bracket outside the maximum. We have a negative maximum, close off the brackets here. Okay, pull that down. So I've condensed both these steps into one step, and I've set it up as one column. And again, we'll take our graph. We'll include that data set in. So add, and we're going to say short put. So this is just the label, short put with premium. We can use lowercase p with premium. What's on the x-axis? Always the stock price, the stock asset price range. And then on the vertical axis, it's the payoff. Right, so we'll include that in and OK. And you can see here we have, okay, so there's something I neglected to do. maximum or 0. Okay, so we have to put a 0 here, right? Otherwise, without that 0, we can't truncate at 0. Okay, so we'll drag that down and set up, right? So the step that I forgot there was put in the 0, and let's drag that down. You can see the blue will correct. Okay, so what we have here by incorporating in that 0, right, we've truncated, and this payoff now is for the short put option is mimicking here what's in our final engineered graph. So again, we want to demonstrate a bull spread using puts. The very last step here is to take the combination, and that's just saying, okay, take the combination of the true. So it's a simple summation of both. We'll drag that down and then incorporate into our spreadsheet, into our graph, select data, add, we can call it portfolio or combination. What's on the x-axis, the asset prices underlying the derivative strategy, and then on the vertical axis, we have the payoff, and hit OK. And you can see here the gray now represents the bull spread, where we have the long put option with the lower exercise, the short put with the higher exercise, and the combination of the two is the gray we can include in our legends, and then put at the bottom, and we're done, right? So we have a long put with premium, short put with premium, and we have the combination of those two positions here. And that yields us our bull spread using put options.